A quiet phone call in Beijing just rang louder than a siren on Wall Street. No press conference. No headlines. Just a single lethal directive. Stop buying dollars. 48 hours later, Spain inked a historic agreement with China. One that could split NATO's economic framework straight down the middle. If you think this is just about trade, you're already 5 moves behind. On April 7th, behind closed doors and under a shroud of silence, Beijing gave a chilling order to its state-owned banks. Immediately cease purchasing US dollars. Sources inside the People's Bank of China confirmed it wasn't a symbolic gesture. It was execution-ready. ICBC, Bank of China, Agricultural Bank, all told the same thing. Slash dollar exposure, reroute settlements into yuan, freeze dollar liquidity. This wasn't theory. This was Act 1. The timing? Surgical. Just 2 days after President Trump escalated tariffs. Just a week after a seismic spike in U.S. Treasury yields. A question now echoes through the canyons of D.C. Is China quietly dismantling the dollar's dominance? Not over decades, but in real time. Wall Street hasn't found consensus, but the panic is real. Goldman Sachs' Hu Shan issued a stark warning to clients. A sudden pullback in dollar demand by China could ignite global volatility and undermine dollar liquidity at its core. Then came the data. In March alone, China offloaded $24.1 billion in U.S. Treasuries. The steepest monthly drop since 2018. This wasn't a whisper. It was a signal. A precise, deliberate message aimed at Washington. And then Spain moved. Publicly, unapologetically. A multi-billion euro strategic pact with China. No coordination with NATO. No check-in with Washington. Just signatures and smiles. The agreement gives Chinese firms direct access to Spain's logistics arteries, green energy infrastructure, and research corridors. Valencia, Bilbao, Algeciras. The largest bilateral investment with China since 2005, bypassing EU ratification entirely. And buried in the deal? Golden incentives for Chinese EV giants, rail system integrators, rare earth refiners. Why does it matter? Because it didn't happen in a vacuum. Just 2 days earlier, Trump imposed a 100% tariff on European EVs, calling out Chinese subsidies leaking into the EU. Spain, caught in the economic crossfire, didn't flinch. They made their choice. Former EU Trade Commissioner Cecilia Malmström put it bluntly. Countries like Spain no longer see alignment with the US as a given. It's now transactional. And if that's true, if loyalty has become a spreadsheet, what happens when other mid-tier economies start running the same math? On April 6th, Trump suddenly paused his $50 billion tariff strike on Chinese tech and autos. The official line? A diplomatic timeout. But the markets told a different story. That same day, 10-year Treasury yields exploded to 4.81%, levels not seen since before the 2008 crisis. According to Treasury data, foreign governments dumped $67 billion in U.S. debt in Q1 2025. Leading the exodus? China, Japan, and Saudi Arabia. Morgan Stanley's chief economist issued a warning shot. If foreign demand for U.S. debt collapses mid-deficit, the system becomes politically toxic and economically unsustainable. So was Trump's tariff delay diplomacy or desperation? Either way, the bond sell-off hasn't stopped. And the question grows louder. What happens if America's creditors keep walking away? What backstop remains? Meanwhile, China's trade machine isn't stalling. It's rerouting. In March 2025, China's exports to the Global South surged 42.6% year-over-year. Electronics, EVs, industrial hardware, all booming. More provocatively, exports to U.S. allies like Mexico and Spain jumped 18.3% and 21.9%. How? New tariff-free pathways, silent corridors. The WTO has raised red flags. Chinese goods are being funneled through Vietnam, Cambodia, and Mexico. Repackaged. Rebranded. U.S. Customs flagged a 23% spike in Vietnamese imports. At the same time, Vietnamese exports to China mysteriously surged. Coincidence? Or strategy? Georgetown trade scholar Jennifer Hillman didn't mince words. Tariffs aren't reducing Chinese trade. They're just changing the address, and in some cases, making Beijing even stronger. So who's really paying for this economic war? April 3rd brought another blow. BYD, China's EV titan, confirmed a $10 billion mega-project in Valencia. 2 auto plants, a battery gigafactory, and a coastal export terminal wired straight to North Africa and the Middle East. Their largest foreign investment ever. BYD has now outsold Tesla for 3 straight quarters. And this new hub could churn out 800,000 vehicles a year by 2028. Spain's deputy prime minister called it the engine of Europe's post-carbon future. But this isn't just about clean energy. It's about leverage. Because while the US plays defense with tariffs, Beijing is quietly redrawing the map, and the rest of the world, they're choosing sides, one deal at a time. No EU country opened its doors to Chinese industrial capital faster than Spain did in the first quarter of 2025. According to the EU's latest report on foreign investment screening, Madrid slashed regulatory approval times by a staggering 43%, outpacing even the bloc's most trade-hungry economies. That single move didn't just raise eyebrows in Brussels. It sent shockwaves through Berlin and Paris, where skepticism toward Chinese capital remains not just strong, but strategic. And yet, while Europe's power centers hesitate, China accelerates. Right on cue, BYD expands its footprint in Europe, just as Donald Trump reignites his tariff war, this time targeting EU auto exports. German automakers are suddenly under siege, squeezed from both sides, US tariffs to the west, Chinese competitors flooding the east. This isn't economic competition, it's encirclement. So the question no one dares ask aloud, is China quietly dismantling the US-EU trade axis, one electric vehicle at a time? Publicly, America's allies nod in unison. They support Washington's trade stance. They parrot its security priorities. But the numbers tell a different story. Behind closed doors and buried in quarterly trade ledgers, the realignment is already underway. According to Eurostat, imports of Chinese electronics into the EU surged 16.4% in Q1 2025. Not in defiance of US tariffs, alongside them. Meanwhile, Australia, a staunch member of the Western Alliance, reported a 21.7% spike in lithium exports to China, even as it reaffirms defense ties with Washington. These aren't policy missteps. These are systemic contradictions. France's Airbus, once the poster child of transatlantic cooperation, doubled its procurement orders from China this quarter, signing $2.3 billion in contracts with AVIC, a state-linked aerospace giant. Even Japan, long a reliable pillar of American policy, imported 11.2% more Chinese semiconductors, despite publicly agreeing to stricter tech controls. As former USTR official Wendy Cutler told Bloomberg, allies are doing what's politically necessary while hedging commercially. The narrative and the numbers are diverging. And if that divergence becomes permanent, the real question isn't who's winning. It's whether the US still holds leverage, or just loyalty. On April 6th, Washington struck back. The US Treasury added 12 major Chinese firms to its investment blacklist, names like TTL, a battery giant, and SMEK, a state-affiliated chipmaker. But the blow wasn't clean, because targeting Chinese companies also means hitting American portfolios. Morningstar data shows more than $412 billion in U.S. retirement assets are passively exposed to Chinese equities through index funds managed by BlackRock, Vanguard, and Fidelity. Blacklisting these companies doesn't just signal resolve. It triggers liquidation cascades, ETF reshuffling, and increased global volatility. When Hikvision was blacklisted in January, redemptions from emerging markets funds topped $3.7 billion. That same pattern is repeating. FTSE Russell is reweighting indices. JP Morgan is warning of mounting pressure on global EM funds. And an internal SEC risk memo, leaked to the Wall Street Journal, warned of a potential disorderly unwind of US-China financial ties if the blacklist expands without structural reform to domestic investment rules. This isn't a precision strike, it's a shot through the global system. And the tremors are already felt at home. Core inflation in the U.S. hit 4.3% in March 2025, driven by rising costs for imported electronics, auto parts, and household goods. Yet real wage growth? Flatlined. Average hourly earnings are down 0.6% year over year. Purchasing power is fading. The American middle class is feeling the squeeze. According to the National Federation of Independent Business, 29% of small firms now cite tariffs and input costs as their top concern, up from just 8% a year ago. And it's not just firms. It's the whole economy. The Institute for Supply Management's manufacturing index just fell to 47.2, its lowest point since the COVID crash. Economist Mohammed El Arian didn't mince words on Bloomberg TV. You can't have simultaneous inflation, weak wage growth, and declining production without risking stagflation. But the deeper issue isn't whether tariffs are politically viable. It's whether they're economically survivable. What happens when voters are forced to choose between groceries and gas? If consumer sentiment cracks, what's next? Recession? Or something worse? Foreign confidence is already slipping. In the first quarter of 2025 alone, foreign holdings of U.S. Treasuries dropped by $138 billion. China offloaded $31.6 billion, its lowest U.S. bond holdings since 2009. Japan, down $23.4 billion. Saudi Arabia, another $11.9 billion gone. These aren't minor portfolio adjustments. They're structural exits, driven by geopolitical risk and dollar volatility. And now the consequences are hitting home. The 10-year Treasury yield soared to 4.89% by April 10th, up from 3.91% just 4 months ago. That spike lifts borrowing costs across the board: mortgages, corporate credit, federal debt. The Congressional Budget Office estimates that every 1-point increase in interest rates could add $2.2 trillion to the national debt over the next decade. And former IMF economist Desmond Lockman warned, if foreign investors flee the U.S. bond market en masse, the Fed could be forced to tighten policy during a recession, a nightmare scenario of stagflation and capital flight. So the final question hangs, unanswered and urgent. If bond demand collapses, the dollar softens, allies hedge their bets, and inflation eats away at wages, what's left holding the system together?